So, listen, bank stocks have acted very poorly. And, if you look at something like Wells Fargo, which used to be a favorite the last 3 or 5 years, it's down 19% year to date in a market that's up 8. And so I'm wondering, the lead steer of this group, JP Morgan, which is the best franchise, best management, best balance sheet, et cetera, is also down year to date. So you have to take note when, big, liquid, well-owned banks start performing poorly. And so in the last couple of weeks, last month, I've been writing about why I think banks are going to roll over. And it's largely because we're at what we call peak PPNR, pre-tax, pre-provision net revenues, PPNR. And essentially what that is total revenues minus operating expenses, but not minus credit costs. So total revenues minus operating expenses. And that, is growing at a mid-teen rate year over year. And it's probably been the best metric that coincidentally, measures up to how stocks perform in my industry of banking. So when PPNR peaks, bank stocks peak. And that was up about 15% in the first quarter year over year. It's probably going to be up anywhere from 12 to 15% here in the second quarter. So another really good second quarter. But bank stocks are selling off into that. And it's, in my mind, it's because in the second half of the year, we're going to see that PPNR rate of growth drop dramatically. And as we exit 2026, we're going to see PPNR growing at a mid-single digit rate. So not a lot of cushion in terms of net revenue growth in this as you exit this year. So the question is, what's going to happen to credit quality? And if we are starting to see corporate credit quality deteriorate here, then credit costs in the second half of the year are going to start to rise because they've been pretty benign so far. Everyone was very, very bullish on banks coming into the year, saying deregulations could lead to multiple expansion and earnings growth, et cetera. And I've been a contrarian on that and saying, I think it's time to sell your bank stocks. So I think that dynamic is what's starting to filter into investors' minds. I bring this up because over the next 3 to 4 weeks, we're going to have 3 different banking conferences, one starting today over the next 3 days, one at the end of May, and one in June. And we're going to start to get some updates from management as to how they're viewing the year. And there are 2 very important revenue metrics that are going to get looked at. One is spread income, what we call net interest income or top line revenues. And at the beginning of the year, when they gave their forecast for spread income, they assumed, 2 rate cuts, mostly in the back half of the year. And that was supposed to help their NII growth. So if today we're taking rate cuts out, will we get updates from various banks about, NII not being as robust as anticipated? And I think that's largely what's behind Wells Fargo's underperformance. And then the second metric is capital markets revenues, things like trading, investment banking, wealth management. And here, I think expectations remain robust. In fact, if you look at Morgan Stanley, it's been making new highs. Goldman Sachs is still within striking distance of its new high. And the one regional bank that's done very well, Citizens Financial, has a big play on capital markets and wealth management. So that's the distinction I think the marketplace is making on the revenue side is capital markets, they still expect to be good. And so that's how you're seeing these stocks disperse because there are stocks that have done well. Citigroup has done very well this year. They just had their investor day and put out some metrics for the next 3 and 5 years, and they were I think they're achievable. So that remains my number.
I saw someone say something about the Citibank. I think the CEO even said in a subsequent interview, someone said, well, it seemed like you were sandbagging. They didn't use that phrase. They said, it seemed like this was very conservative. And like, yeah, there's room to go higher. I was like, well, yeah. Do you think that's the case? Do you think it's a little bit, is it below where you are for the year?
No, I wrote a report after that investor day called Keeping It Real. And the analyst community did push management to say they were being too conservative in their targets. And the thing you have to understand is the upside to Citi is around things like investment banking, wealth management. And those are heavily dependent upon the capital markets remaining robust and asset prices rising. And it's hard, when you're at 74, 7,500 on the S&P, to think that prices can rise dramatically from here. And if we are moving towards a credit cycle on the corporate side, it's hard to believe that credit quality is going to remain benign. And so I think management is much more realistic about the operating environment in 27, 28. I'm not talking about this year. I think this year is a lock, for a lot of these companies. But 27, 28, there's a lot of uncertainty when you start thinking about the macro environment and the capital markets. So I think they were being conservative. If we have a robust GDP growth, then those targets will be beat. But I'd rather them build their credibility, because for the last 2 decades they've had no credibility.
Hey, Charlie, when you talk about the banks rolling over, is it predominantly earnings have to come down, or is it a combination of earnings coming down and the multiple or percent of book that these stocks trade at coming down also because you've gotten past those peak earnings?
And it's probably going to, you're not going to see anything to confirm my concerns until the second half of the year, because the second quarter is going to be very robust again. But I do think, there's a credit cycle developing there. And maybe that's why, they're buying the Goldman Sachs and the Morgan Stanleys, because there's no credit risk, or perceived to be no credit risk. And they're selling the Wells Fargo because there is a credit risk there. It's interesting. People used to think that Wells Fargo would not have credit problems because they had the asset cap for the last 5 years and couldn't grow their balance sheet. Well, the last 2 quarters, they've had big jumps in their C&I, their corporate, problem asset pool. So that thesis is not playing out either. But yeah, it's hard because, as I said, you're going to have a good first half, and you had a good first quarter, and the second quarter shaping up to be good. But it's the second half that I think the market is starting to worry about, if the credit cycle is turning on us.
Hi, I'm David Maris. If you like what you just heard, we've tracked every single pick we make on the show, every ticker, every thesis, every entry price, over 1,100 picks and counting. We put it together in a free report with our top 10 performers, the reasoning behind each one, and a preview of our full dashboard. If you want access, the link is in the description.